Prediction markets have gone mainstream. Now you can price politics and policy like a bond yield. The crowd is saying 2026 looks like split government, a steady Fed, non-zero recession risk, and policy brinkmanship priced in. And that backdrop is exactly the kind of volatility setting where markets can climb a wall of worry anyway. Let's talk about something that has quietly changed how people think about the future. Prediction markets. Not some nerdy corner of the internet anymore, I can tell you that. They've slipped into the mainstream almost without anybody noticing. You can now price a policy outcome the same way that you price a bond. Bid, offer, implied probability, all that stuff. And you can watch the crowd change its mind in real time, just like a trading desk marks risk after a headline. Now, that doesn't mean that these markets are right. They're not oracles, but they are a live read on what people are willing to pay to be right. And in a world where everyone talks with certainty, but nobody wants accountability, well, that's worth paying attention to. When you look across these markets for 2026, a few themes jump off the page, and they paint a very familiar, very market-friendly kind of picture. First, the crowd is leaning hard into a midterm pendulum. The prices imply a strong expectation that Democrats end up controlling the House after the 2026 midterms, low 80% in one market, while Republicans are still favored to hold the Senate. That's somewhere in the mid-60s in terms of probabilities. And that's not a sweep, that's gridlock. And here's the funny part. Investors pretend they hate gridlock. Then they secretly love it, because gridlock limits policy surprise, and gridlock makes big ideas harder to execute, and gridlock tends to turn politics into noise, not action. If the House is Democrat and the Senate is Republican, Washington spends more time investigating than actually legislating. That's a lot of sound and very, very little signal. Markets are comfortable with that, surprisingly, but that's how things work these days. Second, the Fed is priced for steady, not drama, at least early on. The odds on no change after the January 26 meeting are around 90%. Cuts aren't dead, but they're not being treated as miracles either. What's more interesting is where the real betting action is. It's not just about rates, it's about people. The crowd is assigning real probability to who comes after Powell. When markets start betting on personnel, well, they're really betting on regime. The message is quite simple. Policy may not move much meeting to meeting, but the next chapter is pretty much already being written. Third, recession risk is there, but it's not the base case. The probabilities put a recession by the end of 26 in the mid, let's say 20s. By 27, still in the low 20s. Well, that's not panic. That's a market saying growth slows, something creaks, but the house doesn't necessarily collapse on itself. For equities, that's a world where earnings can still grind higher, but multiples stop getting a free lunch. For bonds, it's a reminder that disinflation is still in the story. It's not just demand. So, fourth, governance friction is being treated as a feature, not a bug. There are meaningful odds assigned to another government shutdown by early 2026. Oh boy, that's not a lock, but it's not a joke either. This isn't about one big shock. It's about a series of self-inflicted paper cuts, funding fights, court fights, tariff fights, and the constant question of who's paying the bill here anyway. When that kind of friction becomes routine, markets stop reacting with fear and they start reacting with shrugs. Fifth, and finally, the world stays messy. A Russia-Ukraine ceasefire by early 26 is priced low, mid-teens. That's not cynicism. Unfortunately, that's realism. Domestic headlines are the same story. Loud, chaotic, often contradictory. Big promises, uneven execution. If you've ever watched a corporate restructuring, well, you've seen this movie before. If you put it all together, you get a very 2026 sounding message. Split government, a Fed that holds steady, at least for now, non-zero recession tail risk, and geopolitics that refuses to wrap up neatly. Plenty of reasons for volatility and plenty of reasons for markets to keep climbing that wall of worry anyway. One last thing. These are prediction markets. They're not divine prophecy. They are not a PhD dissertation with robust standard errors. They are bets with narratives, incentives, thin liquidity, and occasional groupthink. Useful? Yes, for sure. Gospel? Absolutely not. So, your truth bomb for today is this. 2026 isn't a single story. It's a distribution of possibilities, and markets are already trading the uncertainty itself. Join me every day for Wall Street Truth Bombs, where I drop them here before the market figures them out.